When you look at the financials of truly massive organizations, and I mean, think about the U.S. Treasury or the largest global corporations, even something like the governing body of a huge condominium complex, they all face this same core problem.
Right. It's a problem of scale.
It's a problem of scale and time. How do you manage these huge, predictable future expenses without, causing a total financial catastrophe when the bill finally comes due?
You can't just hope for the best.
No, exactly. They can't just rely on uh, surplus cash flow or the hope that a massive billion-dollar bond issue that matures in 20 years can somehow be magically pay off with today's revenue.
That kind of thinking, if you can even call it that, is just a recipe for disaster.
A recipe for instability and crisis. So what's required is something more rigorous. It's financial engineering.
It is. It's the creation of a dedicated, often legislated mechanism that ensures the cash is there on time and without causing what the sources call heavy disruption to the financial system.
And today we are undertaking a deep dive into that very mechanism, the sinking fund. At its simplest, it is a fund. It's established by setting aside revenue over a period of time to achieve one of two goals.
Right. Either to fund a future capital expense, like replacing a huge piece of equipment, or, and this is the more common one,
The repayment of a long-term debt. It's basically financial discipline that operates on autopilot.
and as we unpack the source material here, one of the first things that becomes really clear is that how this term is applied is deeply, deeply tied to regional financial practices.
Okay, so it's not a universal definition.
Not at all. And that immediately establishes the scope of what we need to cover. So for instance, if you are operating in North America or in financial markets where corporate and government bonds are, the dominant form of long-term debt.
Which is most of them.
Right. In that context, the sinking fund is almost exclusively associated with bond repayment. It's about the structured, orderly retiring of indebtedness. It's fundamentally a debt management tool for avoiding a liquidity crisis.
Okay, so that's the North American model. What's the alternative?
Well, on the other hand, if you look at the United Kingdom, where corporate bonds were historically less common and long-term leasehold tenancies are the norm, the sinking fund primarily relates to capital management.
So not debt.
Not debt, but assets. It's used for the replacement or the renewal of large fixed assets. The classic example is the common parts of buildings.
So whether we're talking about a government making sure it can repay billions in debt or a building manager making sure they can replace the roof on time, the fundamental goal is the same.
Exactly. You are engineering the future by smoothing out those jagged peaks of financial necessity.
Our mission today is to provide you, the listener, with a clear, structured understanding of this concept. We are going to trace its really surprising history from, believe it or not, 14th century governmental budgeting.
A long way back.
A long way back. Then, through the intense political and fiscal battles in 18th century Britain, to its highly technical role in modern bond markets, and then finally, its unexpected and, frankly, democratic application in personal finance. Okay, let's unpack this.
We began our journey not in, the halls of modern corporate headquarters, but in the highly dynamic and mercantile world of 14th century Italy.
This is not where I expected this story to start.
It's a surprise to many, but it's here, in these thriving city-states, that we see the conceptual origins of the sinking fund. The sources confirm that the idea really emerged with these commercial tax syndicates in the Italian peninsula.
And what were they using it for?
They devised this mechanism primarily to retire the redeemable public debt of those city-states.
Redeemable, so that's key.
That is absolutely key. This wasn't about perpetually paying interest on debt that never goes away. This was about establishing a mechanism to buy back the debt that was due or callable before its formal maturity.
So the foundation was this idea of setting aside specific, predictable streams of revenue for a very specific debt target.
Precisely.
But the sinking fund truly gained its historical significance when it was, transported to Great Britain and applied to the colossal, perpetually growing burden of the British national debt in the early 18th century.
Yes, and this is where it really gets political.
Robert Walpole, starting in 1716, he was the first to implement a form of it in Britain.
Yeah.
And it had some initial success, in the 1720s and early 1730s. The premise was sound. Dedicate funds to paying down the debt.
Right.
But Walpole's fund had a fundamental structural flaw, a flaw so obvious in retrospect that it really reveals this difficult balance between legislative intent and, political reality.
And the source material is very, very clear on this deficiency. Walpole's fund received only the annual national budget surplus.
Leftovers.
Exactly. It was explicitly fed the leftovers. It lacked any guaranteed priority in the government's spending strategy.
Which, when you think about the 18th century British Treasury, I mean, they were constantly under pressure.
Constantly. Wars, political bribes, infrastructure needs, you name it. So if the sinking fund was merely a repository for cash, the government hadn't managed to spend that year.
It's just a piggy bank waiting to be smashed.
It was incredibly politically vulnerable. The Treasury frequently and, inevitably raided the fund. The money was technically earmarked for debt repayment, but because the mechanism lacked any legal ring fencing or priority status, the government just treated it as a convenient, deep reserve of cash for immediate needs.
So it was an institution destined for failure, not because the idea was bad, but because it lacked integrity.
It lacked integrity, not just funding.
And this structural deficiency, this constant raiding, is what led to the critical reform moment. And it came from a very unlikely figure, Richard Price.
Right.
In 1772, Price, who was a nonconformist minister known for his statistical acumen and political dissent, published this hugely influential pamphlet on debt reduction.
And he diagnosed the flaw in Walpole's system perfectly.
He did. He said, any fund that isn't legally mandated and guaranteed will simply be plundered by politicians who are facing immediate needs. It's human nature.
And Price's rigorous logic, it caught the attention of William Pitt the Younger, the brilliant young prime minister at the time. Pitt understood that the only way to make the sinking fund work was to elevate it from, say, a political aspiration to a legally enshrined financial obligation.
So that brings us to 1786, the year of Pitt's Great Reform.
It does. Lord North first recommended the creation of a fund to be appropriated and invariably applied for debt diminution. And Pitt took this concept, this invariably applied, and built an unassailable, or so he thought, legal structure around it.
How did he do that? How did he address Walpole's failure?
He introduced specific legislation designed to prevent ministers from raiding the fund in times of crisis. He wasn't relying on good faith or promises. He was trying to legislate financial stability.
But wait, I mean, if the government can simply change the law, how protected was it, really? Wasn't that just a temporary political fix that could be undone by the next crisis or, the next parliament?
That raises an important question, and Pitt's genius was in making the mechanism self-sustaining and mandatory. That made it politically much harder to overturn.
Okay, so how?
First, he didn't wait for a surplus. He increased taxes specifically to guarantee a dedicated stream of £1 million would flow into the fund every single year.
So it was funded first.
It was funded first. This was mandatory, whether the budget ran a surplus or not. And second, and this is perhaps more important, he depoliticized the management.
He took it out of the hands of the politicians.
He tried to. Administration was placed in the hands of the commissioners for the reduction of the national debt, an external body designed to act independently of the sitting government's immediate needs.
So it's an attempt to make debt reduction an administrative function, insulated from all that political maneuvering.
That's the idea.
And for a brief, glorious moment, it actually worked.
It did. The discipline paid off dramatically. Between 1786 and 1793, the commissioners received £8 million in these mandatory payments.
And crucially, they weren't just saving the money, were they?
No, they were reinvesting the funds strategically, which allowed them to reduce the total national debt by over £10 million. It proved that disciplined, ring-fenced financial engineering could indeed work on a massive national scale.
But as you pointed out, no legislation can withstand a geopolitical cataclysm.
And that's exactly what happened. The success window was short-lived. The outbreak of war with France in 1793, as the historian Eric Evans noted, destroyed the rationale of the sinking fund.
That phrase, destroyed the rationale, is so telling. It wasn't that the politicians just immediately raided it, though that happened later. It's that the sheer, overwhelming cost of funding the war required borrowing on a scale that completely dwarfed that £1 million annual contribution.
The state's priorities shifted overnight. It went from slow, cautious debt reduction to immediate, massive leveraging just to survive the conflict.
The required war debt made the sinking fund functionally irrelevant.
Exactly. And while the fund did limp along for another 2 decades because it was legally protected, it was no longer effective in controlling the total national debt.
So when was it finally abandoned?
It was formally abandoned by Lord Liverpool's government in the 1820s. It stands as a testament to the fact that an extreme fiscal crisis will always supersede even the most well-intended institutional safeguards.
So the British learned the hard way that a truly effective national sinking fund seems to be a casualty of major conflict. But the concept itself, that was too powerful to die. It found fertile ground in the young United States.
Indeed. Following the path of Pitt, the very first United States Congress established its own federal sinking fund commission. The idea of dedicated, structured debt repayment became fundamental to the integrity of early American finance.
By the 19th century.
By the 19th century, sinking funds were ubiquitous in high-growth, highly leveraged sectors, particularly the railroads.
Okay, so the railroads.
These companies were issuing enormous amounts of long-term debt to lay track across the continent, and their creditors needed assurance they wouldn't just default on that final balloon payment years down the line.
And this necessity led to some significant friction, right? Between the debtors, the railroads, and the creditors, or the government guaranteeing the debt.
A lot of friction. We see this play out in the courts in 1878 with the In re sinking funds cases, where the Central Pacific Railroad Company challenged these mandatory sinking funds.
And the company's motive here is key. They challenged the mandatory nature of the fund because it restricted their immediate access to capital.
That's right. They wanted the flexibility to use their revenue for immediate operational needs or for other investments, rather than having it locked away for a debt that wouldn't mature for decades.
And what did the court case reveal about the U.S. system?
The details confirm the strict mechanisms designed for integrity, again, echoing the lessons from Pitt. The legislation required the fund to be invested by the Secretary of the Treasury, preferably in 5% U.S. bonds.
Okay, but there was another detail that you found fascinating.
There was. It shows the incredible effort to ensure transparency and prevent asset diversion. It's the requirement for the bonds themselves. All bonds belonging to this fund had to be physically stamped. Stamped to indicate that they belonged to the fund and were invalid in the hands of any other holders.
Wow, that is a physical manifestation of a legislative firewall.
Precisely. That stamp served as a clear, undeniable audit trail. It ensured the fund's assets couldn't be easily misappropriated or sold off without explicit legal authorization. The entire accumulated sum was then, at maturity, applied directly to the payment of the original debt.
It's a remarkable example of how financial discipline, whether for a government or a massive corporation, requires these external, visible checks and balances.
It really is.
That historical struggle between fiscal planning and immediate political or corporate necessity sets the stage perfectly for the highly technical world of modern corporate bond finance. The principles remain the same, but the mechanisms have become intensely strategic. Here's where it gets really interesting.
Moving into modern finance, the core definition, it still holds. A sinking fund is a provision that requires a corporation or an organization to periodically set aside money to retire indebtedness.
And that indebtedness can take many forms, right?
It can. We're talking regular bonds, debentures, even preferred stock. It is explicitly a way to avoid the risk of a bullet payment, that huge lump sum at the end, causing a liquidity crunch upon maturity.
And we don't just see this on Wall Street. We see the seriousness of this mandate even at the local level. Our sources cite the example of Michigan school districts.
Right, where they can seek voter approval for a sinking fund tax levy.
In this local example, it perfectly highlights the non-negotiable sanctity of the fund. The state Treasury Department imposes these incredibly stringent expenditure guidelines.
And the penalties are severe.
They are. If the district misuses the money, say, they use the capital fund for operating expenses or salaries instead of the specified debt repayment or asset purchase, the penalty is an eternal ban on ever seeking that sinking fund tax levy again.
An eternal ban. That underscores the idea that these funds are dedicated and they are untouchable.
Absolutely. The debt holder sees that level of commitment and recognizes, okay, there's reduced credit risk here, which is why these bonds often have favorable terms.
But for the issuer, the mechanics of how they use the accumulated funds to retire the debt are varied and strategically crucial. We really need to detail the 4 distinct types of sinking fund operations for bonds that are identified in the sources.
Okay, let's start with the simplest. Mechanism number 1.
Mechanism 1, open market repurchase. This is the most straightforward. The firm simply takes the required sinking fund cash and repurchases a fraction of its outstanding bonds directly in the open market each year.
So if the bond indenture, the legal contract, says they need to retire $5 million in debt this year.
They just go out and buy $5 million worth of their own bonds on the exchange. Simple as that.
And when is this most advantageous for the issuing firm?
It's most advantageous when interest rates have risen since the bond was first issued.
Because when rates rise, Existing bond prices fall.
Exactly. So if the firm can buy back its debt at, say, 90 cents on the dollar, they fulfill their sinking fund obligation cheaply and efficiently. They get to purchase their own debt at a discount.
Okay, that's clear. Now moving to mechanism number 2, which introduces the complexity of call provisions.
Mechanism 2, special call price repurchase. This mechanism only applies to what are known as callable bonds. This means the firm has the right to call or force the sale of the bonds back from the investor before maturity.
And with the sinking fund.
With the sinking fund, the firm repurchases a fraction of the outstanding bonds at a specific, predetermined special call price that was written into the bond indenture when it was first issued.
And that price is usually...
It's usually par value, so $1,000 per bond.
The key here, then, is that the call price is locked in.
It's locked in. So if the market price of the bond goes sky high because interest rates have fallen, the firm can still buy back the bonds at the lower, locked-in sinking fund call price.
This is where the strategic maneuvering really begins to take shape, which brings us to mechanism number 3, the optional choice.
Yes. Mechanism 3. The optional choice. And this is the most tactical of all the mechanisms. Here, the firm retains the option to retire the bonds either by buying them at the current market price or by using the sinking fund call price.
Whichever price is lower.
Whichever is lower. The firm is essentially guaranteed the cheapest retirement method available at that moment.
Okay, let's walk through that. Suppose the required sinking fund retirement is, say, $20 million this year.
Okay, so if interest rates have risen, the market price of the bonds might be $950 per bond, which is below the $1,000 par or call price.
So the firm chooses the market price.
They choose a market price, spending less than par to retire the debt. Now, on the other hand, if interest rates have fallen, the market price might be, say, $1,050 per bond.
So now it's a premium bond.
It's a premium bond, selling above the $1,000 par price. The firm exercises its sinking fund option and calls the bonds at $1,000.
Saving $50 per bond compared to buying them on the open market.
Exactly. In both financial environments, the firm gets to choose the most advantageous path for itself.
But how do they decide which bondholders to hit with that mandatory call if they use the sinking fund price? I mean, they can't just pick on small investors, right?
No, fairness is built right into the indenture. To ensure the burden of the call is allocated fairly, the bonds chosen for repurchase, especially if the sinking fund price is the cheaper option, are selected entirely at random.
Wow.
Typically based on the serial number of the bond certificate. It's literally the luck of the draw for the bondholder.
Yeah.
And furthermore, some indentures include what's known as the doubling option.
The doubling option.
This allows the firm, if they are calling the bonds at that favorable sinking fund price, to repurchase double the required number of bonds. So if they're required to retire $20 million,
They can retire $40 million?
they can retire $40 million. This allows them to rapidly shed expensive debt when interest rates are low, which is an enormous strategic advantage.
That doubling option accelerates debt repayment exactly when it's most financially beneficial for the company. It's them maximizing the embedded option they hold.
Precisely. Now, that brings us to mechanism 4, the investment model. This is the least common method today, but it aligns most closely with the historical idea of just building up a segregated fund.
So what happens here?
Here, the firm makes periodic scheduled payments to a trustee, a third party, who then invests those payments, usually in very safe, highly liquid instruments like government bonds.
So the company's original debt remains outstanding the entire time, correct? They aren't paying it down piece by piece.
That is the critical distinction. The debt remains outstanding, but the company is simultaneously building a segregated asset managed by the trustee.
And the accumulated sum.
The accumulated sum, including all the investment earnings, is explicitly designed to perfectly match the maturity date and the entire face value of the outstanding issue. When the debt matures, the trustee liquidates the accumulated fund and retires the entire liability in one go.
So it's an accrual method rather than an amortization method.
Good, perfect way to put it.
And we noted this was specifically popular in the UK household mortgage market during the 1980s and 1990s. This just shows how the same fundamental mechanism can manage a multi-billion-dollar corporate debt or a single family's long-term home loan.
The principal scale.
We've established the mechanics. Now let's zoom out a bit and analyze the core benefits and, well, the resulting dilemma for the creditor. For the organization issuing the debt, the benefit seems simple and profound: stability.
Right.
They ensure the principal is available when it's due, which prevents a sudden huge payment that could cause, as we said, heavy disruption to their entire financial position. It ensures continuous liquidity.
And for the creditors, the investors holding those bonds, the benefit is a crucial reduction in credit risk.
You have an assurance.
You have an assurance that the debtor has been preparing for years, mitigating the possibility of default caused specifically by a massive balloon payment they can't handle. But
Here's the catch.
here is the major caveat, especially with callable bonds under mechanisms 2 and 3. That benefit of reduced credit risk comes at a cost to the creditor, because the sinking fund structure often gives the issuing organization a hugely valuable financial tool, an embedded option on the bond.
This is a complex point, so let's take a moment to ensure you, the listener, understand the underlying dynamic that makes this option so valuable. We need to be clear about the relationship between interest rates and bond prices.
Absolutely. The fundamental relationship is inverse. When market interest rates rise, the price of existing fixed-rate bonds falls.
And the opposite is true.
Conversely, when market interest rates fall, the price of existing bonds rises, making them premium bonds. And this is simply because investors will always seek the higher available rate.
Okay, so armed with that fundamental principle, let's connect this to the bigger picture. Because the firm holds the option, the right to call the bond back at a preset price, they get to act strategically based on those market movements.
And in doing so, they effectively transfer the risk of price volatility to the bondholder.
Let's walk through the two core scenarios from the perspective of the firm exercising its sinking fund choice.
Let's do it. Scenario 1. Rates rise. Prices fall. Suppose a firm issued a bond at 5%. If market rates suddenly jump to 7%, that 5% bond is now undesirable, and its market price falls to, say, $950. It's a discount bond.
So the firm's option allows them to choose the lower the market price, $950, or the call price, $1,000.
And they choose the market price. They retire the debt cheaply.
The firm wins by getting cheap debt retirement. But the bondholder is already losing because their asset value has declined, and now the firm buys it away from them at that low market price.
Right. Now, scenario 2. Rates fall, prices rise. Let's take that same bond issued at 5%, but now market rates collapse to 3%.
That 5% bond is now highly valuable.
Highly valuable. Its price soars to, say, $1,050. It's a premium bond. The firm again looks at its optional choice and sees a market price as $1,050, but their sinking fund call price is $1,000.
So they choose the sinking fund price and call the bonds back at par.
They do.
So the firm wins again. If interest rates move in a way that would make the bondholder rich by raising the price of the bond, the firm simply exercises its option and takes the bond away at a lower price. It essentially caps the upside for the bondholder.
Correct. The firms gain their ability to lock in a purchase price and strategically buy back debt when it's cheapest for them is the exact value of that embedded option. The bondholder, on the other hand, is deprived of the favorable price movement that comes with falling rates because their bond is called away from them at par.
So the firm's gain is demonstrably the bondholder's loss of that potential premium.
It is a zero-sum transfer.
This raises an important question then. Why would any rational investor buy a bond that allows the issuer to transfer all the price risk to them? Why would you agree to this structure?
The answer is they must be compensated upfront for giving the firm this powerful flexibility. The value of that option has to be priced into the security from the very beginning.
So how does that compensation work?
The valuation conclusion is that callable bonds, which include these sinking fund provisions, must typically be issued at a visibly higher coupon rate, a higher interest payment than non-callable debt of the same quality and maturity.
Ah, so you get paid more interest along the way.
Exactly. That higher rate is the compensation the creditor receives for essentially selling the firm the valuable option to call the debt early. It is an explicit, measurable cost that is baked into the structure of the debt from day one.
What's fascinating here is that the sinking fund, which seems like a pure risk reduction tool, is simultaneously a sophisticated risk transfer mechanism that requires the issuer to pay a premium for the flexibility it provides.
It shows the incredible nuance in long-term financial structuring.
Now let's pivot entirely away from corporate leverage and bond markets to look at the other core application of the sinking fund, managing capital expenditure and assets. This is a world that is often more tangible for the average person.
Absolutely.
Sinking funds are vital for asset management, particularly for long-lived assets like buildings or major industrial equipment. They are used to systematically set aside money for replacing equipment as it becomes obsolete, or, just as importantly, for major maintenance and renewal of core elements of a fixed asset.
Think about managing a large apartment complex or a city maintenance department. They know with almost total certainty that the central chiller unit will need a total replacement in 15 years.
And that the parking lot will need resurfacing in 10.
Right. And these costs are massive. We're talking hundreds of thousands, potentially millions of dollars, but they are entirely predictable. If they wait until the equipment fails, they face a crippling, immediate bill.
Which they will inevitably try to pass on to tenants or taxpayers in a sudden, painful assessment.
And nobody wants that. The sinking fund here prevents that pain by ensuring that the cost is allocated over the asset's useful life. Every year, a small portion of the expected replacement cost is set aside.
This brings us back to those terminology differences in the UK, where this asset management application is particularly prominent, especially regarding service charges on commercial property and residential management codes.
Yes, the sources reveal a really interesting historical nuance here. Historically, property management codes in the UK maintained a very strict distinction.
Of what?
Sinking fund was used exclusively for the eventual replacement of an entire asset, like a full elevator system, when it reached the end of its life. Meanwhile, a reserve fund was used specifically for major maintenance or renewal of existing elements.
So replacing a roof or updating boiler component.
Exactly. Replacement versus renewal reserve.
So sinking fund versus reserve fund.
But the sources note a crucial shift since the mid-2010s, specifically referencing guidelines from bodies like the Royal Institution of Chartered Surveyors. These terms are now used interchangeably in the UK context.
So it's all just one pot of money for future work.
It's often just referred to as reserve funds or sinking funds designed to meet all the irregular anticipated future costs associated with managing the property. The goal remains unified: periodic contributions to avoid future financial shocks to the leaseholders.
And finally, we arrive at the most democratic and accessible application of this centuries-old financial engineering tool: personal finance.
This is where it really comes home for a lot of people.
It does. The dry historical term has been enthusiastically adopted by modern financial literacy and budgeting movements. If you practice zero-based budgeting or follow popular cash envelope systems, you have undoubtedly been told to use a sinking fund.
It has gained massive popularity as a fundamental personal finance hack that helps people manage the real world of expenses.
And the core function remains precisely the same: to smooth out financial shock. But the context changed the definition just a little bit.
It does. For a person, a personal sinking fund is a dedicated category or a bucket in their budget where money is consistently allocated towards future expenses.
And these expenses can range wildly, can't they?
They really can. They might be long-term, like saving for a down payment on a new car, or intermediate, like allocating money monthly for annual insurance premiums or property taxes. They can even be surprisingly short-term, like saving up for holiday gifts or a summer vacation.
The key is that they are known, infrequent, and larger than a normal monthly budget can handle on its own.
That's the critical distinction compared to the corporate funds. It's not strictly for debt or capital replacement, but for managing any irregular, lumpy expense that would otherwise force the individual to turn to credit cards or deplete their emergency savings.
And unlike the corporate and governmental sinking funds we detailed, which are often legally mandated and governed by strict indentures, the money in a personal sinking fund can be taken out at any time.
The rigor is entirely self-imposed. It's about building a savings habit that removes the surprise factor from large but predictable expenses.
It transforms a potential financial crisis into a non-event.
It's the same engineering principle used by William Pitt, scaled down to your household.
What an extraordinary journey. We've seen the sinking fund fail spectacularly against the pressures of the Napoleonic Wars, be literally stamped onto U.S. bonds to ensure integrity during the railroad boom.
Define the strategic cost of corporate leverage through that embedded option mechanism.
And finally, show up in your personal budget to save you from that dreaded annual car insurance bill. At its core, the sinking fund is a profound acknowledgement of future reality.
It is. It's a tool designed to smooth out financial shock and demand discipline institutionally.
Whether that's saving a government from crippling debt, optimizing a corporation's bond obligations, or just making sure an individual can handle a major repair without a crisis.
And that leads us back to the dramatic historical failure we covered earlier. We discussed how William Pitt's highly principled sinking fund of 1786, the one that was successful, legally protected, and guaranteed, was nevertheless destroyed in 1793 when war with France erupted.
Right.
The fundamental purpose of any sinking fund is to ensure that money is available regardless of future circumstances to insulate the entity from external shock. Therefore, the failure of Pitt's mechanism suggests a profound limitation.
That even the most carefully constructed and legislated fiscal mechanisms struggle to function.
Or are rendered functionally obsolete when the fundamental predictability of the economy or the geopolitical environment is suddenly and violently gone.
So does this historical precedent mean that sinking funds are merely tools for optimizing an already stable world?
And are essentially defenseless against true national or global crises that fundamentally change the rules of the financial game. That's something for you to mull or explore on your own.
Food for thought indeed. That's all the time we have for this deep dive. Thank you for tuning in, and we'll see you next time with another stack of sources to unpack.